Your tax advisor just saved you $40,000. So why does your bank account feel exactly the same? Welcome to the most politely choreographed illusion in personal finance, where savings often means something very different from what you think it means. Every year, millions of people hand over thousands of dollars to professionals who hand back a document full of impressive sounding deductions. And somewhere in that transaction, the definition of saving money quietly gets rewritten. A tax deduction is not a dollar for dollar rescue. Spending $10,000 to save $3,000 in taxes is still losing $7,000, and nobody's putting that on a brochure. The mechanics here are almost poetically backwards. The system rewards you for spending, depreciating, and structuring, which means the advice optimized for tax efficiency is not always the advice optimized for actual wealth. It's like your doctor prescribing you a gym membership to cure loneliness, technically logical, structurally absurd, and very expensive. The catalyst behind most of this confusion is that the tax code was genuinely built to incentivize certain economic behaviors, real estate investment, business ownership, retirement contributions, not to make regular people wealthy through loopholes. But the industry around interpreting that code has, over decades, developed a language designed to sound more powerful than it actually is. Think about 2017, when the Tax Cuts and Jobs Act passed, and suddenly every financial influencer and CPA on the internet was breathlessly explaining how you could write off your home office, your car, your dog, your vibe. The optimism was electric, and then reality arrived like a very boring audit notice. The psychological damage of misunderstood savings is real and underappreciated, because once someone believes they have a strategy, they stop questioning it. Nobel-winning behavioral economist Richard Thaler once described this as mental accounting. Humans treat money differently based on where it comes from and where it's labeled, which is exactly how a refund check feels like a windfall, even when you overpaid all year. Historically, every decade has its version of this story. The 1980s had tax shelter partnerships that collapsed spectacularly. The 1990s had S-corp loopholes that got quietly legislated away, and the 2000s introduced cost segregation strategies that still work but require scale. Most people don't have. Each era produced a wave of people who thought they'd cracked the code, then discovered the code had been updated without their consent. Here's the broader pattern worth naming. Tax optimization exists inside a cycle of legislation, exploitation, correction, and new legislation, which means any strategy that sounds too clean is probably already on someone's radar at the IRS. The community of savvy investors will tell you, and they're right, that the best tax strategy is the one boring enough that no one ever challenges it. The biggest misconception to dismantle is that aggressive tax strategy is the same as smart tax strategy, because they are not the same thing, and conflating them is how people end up in payment plans with the federal government. Deferral, depreciation, and entity structuring are legitimate tools, but they require the right asset base, the right income level, and the right professional, not just the most confident one in the room. The practical lesson history keeps teaching is that the people who win long-term aren't the ones who found the cleverest deduction. They're the ones who built assets that generate income, use tax strategy as a complement to that income, and never confuse tax efficiency with financial freedom. Moderate, boring, documented, defensible moves compound quietly, while the aggressive plays make for much better podcast episodes and much worse IRS outcomes. Discipline in this space means keeping your actual financial picture, cash flow, net worth, liquidity as the primary metric, and treating your effective tax rate as a secondary optimization problem, not the main event. Process, consistency, and correct position sizing in your investments will always outperform the search for the perfect deduction that unlocks everything. There's a quiet philosophy underneath all of this. The goal was never to zero out your tax bill, it was to build a life where the taxes you pay are evidence of real growing income. Sizing your ambitions correctly, staying consistent with your strategy, and resisting the seduction of complexity will serve you far better than chasing a number on a worksheet. And honestly, whether the tax code tightens next year or opens up new opportunities, none of it changes the fundamentals: assets, income, time, and and a clear head will always be the actual savings plan. Rational preparation means you're not betting on any one administration, loophole, or advisor to rescue you. If any of this made you want to actually build the kind of financial foundation that makes tax strategy meaningful real estate, smart lending, or solid contracting work, check out our links in the description below, because that's exactly where we can help you get started.